Yeah, welcome back, everyone. I've been barbecuing all day, and I've been drinking all day, and I've been smoking a little bit. You know what I mean? The good stuff from the government there, and yeah, elbows up or bottoms up or whatever the case is. Happy Canada Day. All right, just joking. I've been making this video, researching for this video, just like I always do every week. Even on Canada Day, here I am, still making this video for you. Like, you can buy a car online, you can bank online, you can find a wife online, you can do many things online, but you can't buy a house online. Why is that? What do you guys think? Do you think you should be able to buy a house online? I think you should, with the assistance of the right people, of course, mortgage brokers, real estate agents, lawyers, all the rest of that stuff. But there is no option to actually buy the house. And we sell homes to people that don't actually see the homes, right? So it's not uncommon for someone to buy a house sight unseen with the right people going and checking it out and verifying all the measurements and the rest of that stuff. But yeah, anyway, let me know what you think in the comments. Okay, so before I get into this week's data, which is all to do with the CMHC report from June 19th that talks about affordability returning to Canada, and we're probably going to reach 2019 levels or something. Anyway, I did analyze it, and I've done some overlays, and I've got a bunch of data kind of to prove my point that their affordability projections are just way off. They're not even on the right page with it, and I wanted to show you why. But let's start off with some X here. This first one's actually from TikTok, but I think this is my new favorite realtor, and you'll see why now. Let's check it out.
You guys are gonna fucking hate me. This house is $1.3 million. 4 bedrooms, 3 bathrooms, located in the pink streets of St. Pete. Please share this with your rich friends. I'm gonna share it with the neckbeards in my DMs who keep offering me money to see pictures of my feet. Joke's on you, I have athlete's foot. I am way too poor to be in this house right now. Seriously though, when I was in elementary school and they would have those canned food drives, they'd be like, Brianna, why haven't you brought in any cans? I'm like, these are going to my house. Write my initials on the top of the can. I bet it ends up in my pantry. You think rich people sit here and talk about how rich they are? Honey, I think we should buy a new vacation home. But darling, the interest rates are over 6%. Who cares? Oh, you're a hoot. Bring me more wine and Xanax. Did you guys ever eat struggle meals as a kid? My favorite one was mixing every condiment we had with croutons. That used to be a struggle meal, and now it's a $65 entree at a Michelin star restaurant. Share this with someone who can afford a $1.3 million home, and then have them DM me because I'm taking sugar daddy applications. That's a joke. Stay out of my DMs, neckbeards.
Okay, so I think we really need more people or realtors like this in our lives. Everyone's so serious and your business, and it's like have a laugh and it's fun, and hey, people like it. She's getting famous out there doing this kind of stuff. One more, just a quick one here. I'm just going to play the start of this. It's just hilarious.
I haven't seen this much wood since I accidentally walked into the men's room at Planet Fitness.
From Mark Slapinski, breaking, Canada Day has been canceled in Brampton. Anyone that celebrates by lighting fireworks can face significant fines. Daniel Foch posted from the Globe and Mail. The bitter truth is that cheaper housing means a retirement crisis for homeowners. And I think that's probably a true sentiment because so many people rely on their house or their equity in their house for the retirement, and especially for retirement homes. I see it all the time. But yeah, so you're going to have a crisis for the elderly or for the young people. It seems these days it's one or the other. Kind of a sad story here. Just talked to a waitress in Edmonton whose rent is $1,600 a month, and her landlord is raising it to $2,000 a month. With her $750 a month utility bill, she said she doesn't think she can make it. Tell me how mass immigration has helped Alberta. I don't know if it's mass immigration or mass migration, but it all started from immigration, that's for sure. And for all those people looking for interest rates to come down even more, Canadians looking for more interest rate relief might be out of luck. RBC says the Bank of Canada is done with rate cuts for this cycle. And this is, of course, an RBC forecast, but they do, I guess, pay some high-price analysts to come up with this stuff. And yeah, I did a chart, actually, and I'll put it on the screen here. For the last 20 years or something, it's been like 10% of the time the Bank of Canada has kept rates in a neutral zone. And we're in a neutral zone right now. I think it's 2.5 to 3.5%. We're at 2.75, or maybe it's 2 to 3. But anyway, we're in a neutral zone now, and it's been 10% of the time only. So I don't know. I don't see it sticking around for that long because they're going to panic and they're going to cut, and maybe they'll have to raise again because inflation will come back. But it's hard for them to keep that in a neutral zone. Okay, now let's get into this report that was released on June 19th from the CMHC-2SLGBTQIA plus group here. And this was about the housing shortages and affordability in Canada. And yeah, they go into it. I read through a majority of this report, mind you, so I might have missed some things. But they talk about affordability and the construction, new starts or completions, and that they need to almost double. but they don't talk about anything else. They just like say, look, for affordability to return, and it says it right here. I'll actually do the text version here. This is the good part here. This chart indicates historical 1990 to 2024 home buying affordability ratios, followed by projected ratios for 25 to 35 period. In 2019, the ratio across Canada markets was at 39% and then increased sharply to 54% in 2024, demonstrating the important loss in affordability during the pandemic period. For the projected period, the line chart is separated into two scenarios. First, indicating the projected ratio based on keeping the business as usual scenario, resulting in a ratio of 53% by 2035, and then a second result of 41% with additional supply, demonstrating how added supply leads to improved home buying affordability and going back to levels last seen in 2019. Now, they focus on the home building or the supply in this report. They don't talk about anything else. They don't even talk about interest rates. They talk about mortgage rates in the calculation, but they don't put focus on it. So the whole focus is affordability and how it relates to supply or home building. And this is the percent of your gross income that you spend on housing, and the housing would include insurance and property tax, of course, and your mortgage. So, we went from 30 to 40%, depending on the year, since, the mid 90s. Of course, if you look back at 89 and 90, this is where the chart starts here on the left side. It was also at over 50% at that time period. So, of course, it went back up, and it's at 54% at the peak. And they expect that if we don't add more supply, more than 245,000 units per year that we're currently on track to build, then it will still be 53% of your income. And this is gross income. So like net income, this is going to be like 75% of your net income will be going towards your housing costs. And again, that includes property tax. And I think utilities, they might have added in there too. Yeah, it does include utilities, maintenance, and insurance. So this is like an astronomical amount, considering we were at that 30 to 40% range. And their whole projection is even at that, we're going to get back to 2019 levels in like the most expensive markets. But again, I read through this and they didn't factor in anything else. Like we have interest rates, we have unemployment, we have all these things affecting the economy. They're just focused on if we don't build 430 to 480,000 homes by 2035 per year, actually starting soon, our affordability won't increase or won't improve. So, of course, the lower this chart or the lower this line is, the better affordability. The higher it is, the worse it is. Yeah, let's take this data now and see how it relates to some other factors that they didn't mention or they didn't get into. But first, I want to go to the number of housing starts. Now, these aren't completions. These are starts because they don't have the completions data, I don't believe, for 2024 yet. So I'm going to use the starts because that is a projection of what's going on in the building and the home building market. So this is again from CMHC here, and this is the completions or the starts data that I'm going to use. So it's both of these sets of data are right from their sources, and I'm going to put them into my own charts now. Okay, so here is their data here. Of course, we just looked at it, and this is the housing starts as per CMHC. And let's see how they relate to each other now. So I've just overlaid them here. I didn't put them into my own charts, but I just overlaid their charts here to see if we can get any similarities or compare and contrast and trends on this. So let's see what we got here. So we have very clearly, starting from the left side here, as the affordability increases, so that line going down, that dark line is affordability increasing, making it more affordable for people, less of your income going towards that housing cost, starts go down. And you can see it's majority of the time that trend holds true. When housing starts go up, affordability increases. When they go down in the middle there, so there is a relationship, and this is again counterintuitive to what they're saying. If we look at the most recent one here, we're up by the 54 there. You can see that housing starts are decreasing, but affordability is improving. Affordability, the cost of the carrying costs are going down. So this is, again, the opposite of what we've been told in this report, but I'm not just going to compare this here. Let's just go one step further here. We do have some anomalies here, and again, the opposite happens, right? In 1994, 1995 there, you can see affordability gets worse and starts goes down, but then the opposite happens in 2012 and 2017. So, but most of the time, they trend together, right? Now, moving on, we're going to add in the interest rates. So interest rates compared to home building or housing starts, right? So there is a very direct comparison correlation or reverse correlation to low interest rates and how they fuel home building. So if you look at the circle there, that black circle, as interest rates came down in the 90s, I'll move my head here. So interest rates came down in the 90s, and housing starts were coming down too. It was a sign of the times. But then you see what happened. They kind of inverted, and from then on, interest rates kept going down, and housing starts went up. Housing starts remained way above like anything for like that decade from in the 90s because interest rates were super low. We had like ZIRP, right? Zero interest rate periods or close to it. So here we have, the first green arrow there on the left. You can see as they drop interest rates, housing starts to go up. Next red arrow there, we can see they just started to raise 2004, 2005 there. They started to raise rates and just a little bit, and housing starts to drop. And they kept raising rates, and housing starts. Now, the mid to late 90s or mid to late 2000s, I should say, was a bull market in real estate. This is before the great financial crisis. So there's lots of activity, but still interest rates went up and housing starts were flat and started to decline. And then you got to the point where, of course, finally the housing starts collapsed after the great financial crisis in the States, which we got off easy on. And then we get to 2009, 2010, and interest rates are like rock bottom. And look at housing starts right in the middle of the page there. Housing starts to start to go up because, hey, money's free. Let's build some houses. Then by 2014, 2015, they had to drop rates again, do some stimulus on the economy, and look, housing starts pick up. And you get to 2016, 2017, they had to start raising interest rates. Housing starts start declining. Then you get to 2020, the pandemic there, the third arrow from the right. And they dropped interest rates down to 0.25% Bank of Canada. And look at housing starts through the roof during a pandemic, mind you, and we're building houses like crazy. But what happens when they started to raise rates in 2022? Look what happens. Housing starts start to decline again. But as soon as they start dropping rates, we got a little uptick, not much, but they did tick up a bit. So it's very closely related, the housing starts and the interest rates. So interest rates is the driving factor. And I say this all the time. But let's look at the next chart here, which is the affordability versus the interest rates. So on this chart, you can clearly see, starting on the left side here, and it starts at the 90s, you see interest rates gradually, or they grinded down throughout the 90s to 2000. They were on this downward trend. They were at 13% in 1990 or so, and they ended off in 2000, right around 5%. So interest rates trended down, and affordability improved the whole time because, hey, it's got less interest to own a house, and it's cheaper, right? You don't have to pay as much interest. And then we get to the 2000s, and interest rates, they went up a bit, right? Again, a big increase because the debt load was a lot more. House prices were more by this time. And look at affordability. Interest rates went up. Affordability declined. The amount of you're paying for a house went up. Then you get to the 2010s, 2010 to 2020. Look at it. They kept interest rates in that near zero, like near zero, between 0.25 or 0.5 and like 1.75, like that's like nothing, right? In the grand scheme of things and in historical terms. And look at affordability. Affordability remained consistent, but affordability remained consistent not because they were building all these homes. They were just building the normal amount of homes. But home building was still, it was very consistent, but it was because the interest rates were low. And then we come to 2020, the pandemic. During the pandemic, mind you. So during the pandemic, everyone's on lockdown. No one has a job. But again, all the stimulus, interest rates at 0.25. Tip Macklem says, hey, go out and spend all your money or all your credit card money. But look at what happened. Affordability got eroded because house prices went to the moon, and then they had to raise interest rates, which made it even worse. So your affordability declined significantly. And of course, it was all driven by the interest rates. And of course, we end off with where we are now, the last two red lines on the right-hand side, as they drop interest rates back down to where they currently are, 2.75%. Affordability has returned a little bit, but it still has a long way to go. So interest rates are the reason that there is affordability or lack of affordability, and they also affect housing starts. And this report doesn't focus on that. It says we just have to build. No one's going to build unless you have low interest rates. So they're stuck in this situation where who's going to finance all these projects when interest rates aren't low? They know no one's going to buy the overpriced homes if interest rates are high or even mediocre. They need ZIRP. zero interest rate periods to spur on, but they can't go any further. They've already been at 0.25%. Where are they going to go next? I don't know. So yeah, I thought that was really interesting, just how they just omitted or failed to mention that and just focused on those housing starts or the supply, and not the reason where supply comes or how it comes to market, and the reason why it's not coming to market right now. Anyway, let me know what you think in the comments, and until next week, I'll see you then.